What if I told you there's a hidden signal in the markets, a really simple ratio that could give us a clue about where stocks are headed next? Today, we're going to dig into this fascinating idea that pits two of the world's most important metals against each other to find an answer.
I mean, that's the dream, isn't it? A financial crystal ball? Well, believe it or not, a 2025 research paper from Rowe and his colleagues argues that a signal like this might actually exist. And, you know what? It's way simpler than you'd think. So let's break down how they found it.
Okay, so here's our game plan. We're going to follow the breadcrumbs just like the researchers did. We'll start with that age-old hunt for a market predictor. Then we'll look at gold, our first suspect, and see why it's kind of a flawed hero. And then the big reveal, how pairing it with a really unlikely partner creates this incredibly powerful economic indicator.
You know, ever since people started trading, they've been on this quest, this hunt for the one thing, that one magic signal, that single metric that could just tell us, hey, stocks are going up, or watch out, they're about to fall. It's basically the holy grail of finance.
So if you're looking for that magic predictor, where do you even begin? Well, the most obvious place to start is gold, right? For centuries, it's been the ultimate safe haven asset. When things get scary and the markets look shaky, everyone runs to gold.
Okay, but here's the catch. Gold kind of has this split personality. Sure, its price skyrockets during a crisis. That's its fear gauge mode. But, and this is a big but, its price also goes up when the economy is booming and everyone's buying jewelry and stuff. So if you see the price of gold going up, what does that even mean? Is everyone scared or is everyone rich? By itself, it's just a really noisy, confusing signal.
And this is where the researchers had their big aha moment. The secret wasn't looking at gold all by itself. No, to get a clean signal, they needed to pit it against something else. They had to find a way to filter out all that luxury good noise and zoom in on its true power as a fear gauge.
So the hunt was on. Gold by itself? Nope, too noisy. Then they tried an idea from some earlier research, the gold to platinum ratio. Makes sense, right? They're both precious metals, so in theory, comparing them should cancel out that good times buying spree. And you know what? For a little while, it actually worked pretty well. And then, bam, Dieselgate happened. Remember that? That whole scandal just crushed the auto industry. And since platinum is a key ingredient in diesel engines, its price just fell off a cliff. And that's when they saw the fatal flaw. The signal was way too fragile. It was tied to the fate of just one industry. They needed something bigger, something that reflected the entire global economy.
And that, my friends, is where our unlikely hero makes its grand entrance. I'm talking about copper. It's not shiny, it's not precious, it's not a safe haven, it's just an industrial workhorse. But here's the thing, copper is so plugged into everything we do that it's earned this awesome nickname, Dr. Copper. Why? Because they say it has a PhD in economics. The logic is dead simple. If the world is building things, buying things, and just growing, then the demand for copper is going to be high, and so is its price.
I mean, just look at where this stuff is used. It's not an exaggeration to say copper is the foundation of our entire modern economy. It's in the walls of our homes, it's in our cars, our phones, and it's absolutely crucial for renewable energy, wind turbines, solar panels, you name it. Its price isn't just about one industry, it's about, well, all of them.
So you can see where this is going, right? What happens when you take the ultimate gauge of economic fear and you put it together with the ultimate gauge of economic growth? Well, you get something really, really powerful.
And that brings us to the key metric in this whole paper, the gold to copper ratio. It's exactly what it sounds like. You just take the price of gold and divide it by the price of copper. Super simple math, but it creates this amazing economic barometer.
Okay, so here's how you read the signal. And listen closely because it's a little bit counterintuitive at first. When that ratio is high, that means gold is expensive compared to copper. Fear is winning. Everyone's pessimistic. And that suggests stocks are probably undervalued and future returns are likely to go up. Now flip that. When the ratio is low, it means copper is expensive. Growth and optimism are in the air. But that might mean stocks are getting a little overheated and are due for a fall.
The easiest way to think about it is like an economic seesaw. You've got gold on one end, that's your fear and contraction side, and you've got copper on the other, that's your growth and expansion side. And just by looking at how that seesaw is tilted, you get this surprisingly clear picture of where the stock market might be going.
All right, so it's a cool theory, but the million-dollar question is, does it actually work in the real world? Well, the researchers didn't just stop at the idea. They threw decades of global market data at this thing, and the results were pretty darn compelling.
16 out of 23.
What's that?
Well, that's how many developed countries they studied, where this little gold-to-copper ratio was able to significantly predict stock market returns a full year into the future. And this isn't just some American thing. We're talking about a consistent signal that worked across the globe. Japan, Germany, Australia, you name it.
So, what's all that predictive power actually worth in dollars and cents?
About 3%. The researchers figured that if an investor actually used this signal, they could have boosted their annual returns by an extra 3%. Now, to put that in perspective, 3% is like the kind of management fee an investor would happily pay for amazing insights. That's a huge amount of economic value. Of course, in the paper, they say it in a much more academic way. You'll see this jargon, MSFEs. Look, all that really means is that the forecasts made by this ratio were way more accurate. They had way smaller errors than if you just blindly bet on the market's historical average. It's just a better guess.
And this next part might be the most crucial test of all. You see, it's one thing to build a model that explains the past perfectly. It's another for it to predict the future. So they tested it on new data it had never seen before. This is called out-of-sample testing. And guess what? It still worked. That's the gold standard, folks. It proves this isn't just some random fluke in the data. It's a genuinely robust signal.
So, when you take a step back, all of this leaves you with a really big question, doesn't it? This gold-to-copper ratio is this amazing bridge between the physical world, the raw stuff we dig out of the ground to build everything, and the financial world of stocks and bonds. And it just makes you wonder, what other powerful connections like this are hiding out there, right in plain sight, just waiting for us to find them?